Sticky inflation, an AI-driven equity boom, and a softer but still uncertain Fed path are colliding across asset classes today, creating a tricky mix of valuation risk and shifting macro support. Welcome to vTalkInsight, Allocator's Lens Daily for June 29th, 2026. Let's start with equities, where tech volatility and bubble concerns are forcing a rethink of portfolio risk. In equities, the core tension is between an AI-powered rally and growing signs of fatigue. Global stocks have just logged 5 straight down days, with renewed weakness in technology dragging indices lower and turning what had been a one-way trade into something much choppier. The S&P 500's earlier surge toward 7,500 was driven by the AI theme, but momentum has faded, and technical signals now point more to a range than relentless upside. Semiconductor shares have just had their most volatile week in a year, with the Philly chip index swinging roughly 10% on volumes well above recent averages. Under the surface, the market is questioning whether hyperscalers' huge AI infrastructure budgets will really earn returns comparable to their older, capital-light businesses. Even after earnings upgrades, the big tech complex has seen material multiple compression, with the so-called mega-cap group moving from around 35 times earnings to the mid-20s as investors worry about free cash flow. Day-to-day, risk appetite is swinging sharply. On one hand, the S&P 500 has shown resilience, even reversing intraday losses to trade higher as optimism around AI capex and hopes for Middle East escalation support dip buying. On the other, Korea's Kospi has dropped 6 to 7%, triggering circuit breakers and highlighting how leverage and retail positioning can accelerate downside in tech-heavy markets. That volatility is feeding a louder bubble narrative. Some analysts now describe U.S. equities as the most expensive in modern history, arguing that every past episode of extreme overvaluation has ultimately fully reverted to its pre-bubble trend. On that framework, a complete mean reversion from here could imply very large downside, even on the order of several tens of percent. Yet the picture is not purely bearish. Market breadth is quietly improving as equal-weighted indices start to beat market cap benchmarks. Small caps have outpaced large caps by roughly 44 versus 30% over the past year, and capital is rotating towards small cap value, metals and mining, and biotech. Investors are also rewarding traditional businesses that integrate new technology effectively, with examples like Walmart outpacing less tech-savvy peers, while some managers are using the tech pullback to selectively add exposure. From here, the key equity catalysts are the upcoming jobs report, the start of earnings season, and midterm election headlines, especially as tail risk hedges and index puts and high-yield spread strategies gain attention against a backdrop of elevated valuations and a VIX hovering in the high teens. Turning to rates, the message is more nuanced than a simple hawkish or dovish label. After a benign personal consumption expenditures report, implied Fed tightening for this year has eased back from roughly 36 to about 31 basis points, suggesting some relief on immediate hike risk. At the same time, economists are revising core inflation forecasts higher and now expect the first rate cuts to be pushed further out. Labor income is running around 4.5% to 5%, and around 40% of the consumer price index basket is still seeing inflation above 3%, levels that look uncomfortable for a central bank targeting too. The new Fed chair has stepped back from strong forward guidance, which means each data print can move the curve more sharply as markets try to infer the reaction function. For now, the yield curve is flattening in a way that looks more like pricing of inflation risk than a bet on a much higher long-run neutral rate, with 10-year treasuries trading below 4.4% and under their 50-day moving average as safe haven demand picks up during equity volatility. Looking outward, headline inflation is expected to drift lower globally over coming months, helped by weaker oil prices, which could ease some pressure on central banks and eventually cap real yields. But with wage growth still firm and the Fed emphasizing data dependence, the next jobs report and upcoming consumer price data remain crucial signposts for how far this rate's repricing can extend. That evolving rates backdrop feeds directly into credit valuations, which continue to look tight despite isolated pockets of stress. In credit, the broad story is one of strong demand and tight spreads, but with clear fault lines in more speculative corners. Capital inflows into public credit remain robust, with demand still outstripping supply, and new issuance expected to stay heavy over the coming year. Investment-grade technology bonds, including recent AI-related issues, are trading only 5 to 7 basis points wider than the overall index, and still near 20-year historical norms. That suggests the market, in aggregate, has not yet demanded a large premium for AI or tech exposure, even as equity volatility around the same names has picked up. The most visible stress point has been SpaceX. After a record $25 billion bond sale, secondary spreads on the 10-year tranche have moved from around 140 to about 160 basis points over treasuries, with reports that some hedge funds bought the deal for short-term gains, amplifying post-issuance volatility. More broadly, tech issuers with persistent negative free cash flow, such as SpaceX and Oracle, are trading weaker, and many market participants only expect a clear improvement in the next 18 to 36 months. Against that backdrop, some allocators are discussing tail risk strategies, including S&P 500 put structures and trades that would benefit from wider spreads and high-yield exchange-traded funds, as a way to balance rich equity valuations and tight credit. Meanwhile, European private equity and private credit continue to attract long-term capital into themes like infrastructure, sovereignty and security, and although upcoming Bank of England stress tests on private markets are being watched closely, industry voices highlight the sector's lack of deposits and short-term funding as a buffer against systemic risk. Those credit conditions set the stage for foreign exchange, where the dollar's strength increasingly reflects both policy and positioning. In foreign exchange, the dollar remains firm but looks increasingly crowded. Many investors are already long the U.S. currency, and the consensus view is that further substantial upside would likely require a renewed and clearly extended Fed hiking cycle, rather than a more finely balanced path now being priced. Expectations for declining headline inflation globally, alongside some easing in oil prices, could also chip away at the dollar's safe haven appeal over time. If core inflation proves sticky while headline gauges fall, relative real yields and policy divergence will stay central to dollar crosses, making upcoming U.S. data releases important for FX as well as rates. Crypto sits uneasily in this mix. Bitcoin is hovering near key support around $59,000, with some technicians warning that a break lower could open the way toward the low 40,000s, while longer-term skeptics point to its lack of clear intrinsic utility and the fact that digital assets have not yet been tested through a prolonged equity bear market. For now, that leaves crypto trading more like a high beta risk barometer than a reliable diversifier, pushing many allocators back toward more traditional real assets when they think about inflation protection. Commodities round out the cross-asset story, with energy sending particularly mixed signals. Brent crude is down more than 20% month to date to around $72 a barrel. Tanker traffic through the Strait of Hormuz is running close to pre-conflict levels, and markets have sharply reduced the risk premium for a major supply shock. That decline in crude supports global disinflation and a more benign backdrop for risk assets, but it masks growing tightness elsewhere in the complex. U.S. oil inventories are at their lowest level since the mid-1980s. Gasoline and diesel crack spreads are at historic highs, even as crude trades in contango, and shallow water on the Rhine is restricting barge capacity just as Europe grapples with a diesel crunch linked to refinery closures, Russian import bans, and reduced Middle East shipments. Given Europe's heavy reliance on diesel, those logistical and geopolitical constraints raise the risk of further upward pressure on regional refined product prices. That could reintroduce pockets of inflation stress even as headline crude prices look well-behaved, complicating the task for central banks trying to judge how durable any disinflation trend will be. Beyond hydrocarbons, the energy transition is a powerful structural theme. Copper demand is projected to outstrip supply by around 30% by 2035 if current trends continue, driven by AI data centers and electrification. While more than $1 trillion is expected to be invested in European power grids over the next decade. In the United States, policy support for semiconductors and critical minerals and advances in drilling technology are boosting the prospects for scalable geothermal power as a baseload solution for rising electricity demand. Gold sits at the intersection of these forces. On one side, record central bank buying, with 45 central banks planning further purchases and the prospect of Fed on hold rather than hiking, provide a supportive narrative. On the other, gold has already fallen about 30% from its January peak and is still trading as if U.S. inflation were at very elevated future levels, leading some to argue that significant froth remains and that lower price ranges are still possible. How gold trades from here will depend heavily on whether rates and inflation surprises break toward the disinflationary oil story or the tighter diesel and metal story. Stepping back, the cross-asset picture shows AI-driven and still expensive equities now colliding with stickier core inflation, a slightly less aggressive but highly data-dependent Fed, and credit spreads that remain tight even as large tech-related deals wobble after issuance. The dollar is strong but crowded. Crypto looks more like high-octane equity risk than a haven, and commodities are pulling in opposite directions, with softer crude helping headline inflation while tight diesel markets, low inventories, and robust copper demand keep medium-term price pressure alive. For allocators, the coming weeks hinge on three clusters of data and events: the U.S. jobs report and inflation prints that will steer the Fed debate, a new earnings season that will test AI and CAPEX narratives, and evolving energy and metals balances that will shape the inflation path in the next year. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.